Well, hello, welcome Marshall Reddick investors. Thank you for joining us today for our 1031 exchange webinar. It's my pleasure to be your co-host today. I wanted to give you a little bit of background about myself before we get started. I have been a licensed real estate agent for about 20 years, specializing in residential real estate. I've been assisting both buyers and sellers with not only their primary residences, but also with investment properties along the way. I also have 7 years of experience in residential real estate financing in the mortgage industry. I'm a California native who's bought and sold dozens of properties encompassing a few states, quite a few states. Recently become involved in private lending, holding mortgages. So I truly live, speak, think, eat all things real estate. It's definitely my passion, and I love doing it. I love talking about it. I love helping people with it. So anyway, a little bit about Marshall Reddick. For those of you who do not already know us and are familiar with us, we are a full service brokerage headquartered in beautiful Newport Beach, California. We've been founded in 1979, so we've been around a little while. What sets us apart, really, we're unlike a traditional brokerage because we really have 3 separate divisions, and we're able to meet the needs of our clients and investors. So what does that look like? First, we're a brokerage. We help you buy and sell locally your personal primary residence or investment property. We also have the ability to help investors in 16 markets that we've had identified as very landlord friendly. We also have property management, and that covers everything from A to Z. Most investors just don't want to be managers or landlords. We take the day-to-day tasks off your plate so you can do what it is that you do best. We do property management best. We do everything from the prepping, the leasing, renovation, maintenance, and everything in between. So it takes the stress and strain off of you to have somebody who's looking out for your best interest. The third thing we do is private financing, which is lending investors for fix and flip transactions. So if you want to fix and flip, we can help you on the loan side. And conversely, if you want to be a lender, you can invest in one of these mortgages and be involved in real estate and not actually have to own the property outright and do the work. So it's a wonderful product for both people who want to own the property and people who want to invest in the mortgage. The other thing I wanted to touch on is our markets. We have 16 major metropolitan markets that we have identified across 8 states. These are all landlord-friendly places. And on the slide, you'll see that the green is where we have corporate offices, AKA boots on the ground. The other markets, we have third-party teams that we've worked with for years and years and do a wonderful job, and we're confident that they are our counterparts in those markets. So we have identified these markets, and these are where we really focus our clients, investors to want to be in. So how do we determine where to invest? Our research is fact-based. It's not opinion-based. It doesn't have anything to do with where you like to vacation or where you grew up. We look at several key factors. Number 1 being the job market. Who are the employers? What are the job opportunities? Then there's the vacancy rate. What is the rental demand? What is bringing in the tenants? Economic diversity. We're not looking for places that would be considered a one-horse town that only has one industry. We want some diversity, so it evens things out. Then there's housing affordability. Are you going to get a return on the price point? Landlord friendly. That is very, very, very important. We look to that very strongly. And strong education is very important. What are the school districts like? Are there universities? What kind of institutions are there for employers to pull from? And then most importantly, I would have to say, is reliable property management. You need to make sure your property is taken care of and profitable. And that's really the key, is once you get down to it, once you've identified your property, you want to make sure that you've got the right people in place to help you with that. And so when you talk to us, what can you expect from a consultation with an advisor? What we do is we go through the who, what, when, where, why and how scenario with you. We start with just basic goal setting. What do you want to do? How do you want to do it? Is it investing? Are you looking to buy your first property? Whatever it is. What is your time frame like? Are we looking to do this in 3 months or 3 years? What is your criteria? What exactly are you looking for? Are you looking for a duplex? Are you looking for a single family? What areas are you targeting? That's identifying your markets. And then most importantly, we introduce you to all the key players, what I like to call our power team. We have everybody in place that you would need, from a conventional lender to a private money lender to an advisor to an agent boots on the ground in your particular market. And anything and everything in between. We have the key players already lined up to work together as a team, and we typically and truly want to work synergistically as a team with you, with all of our key players. So that's a little bit about Marshall Reddick. And one of our key players that has been with us is our 1031 Exchange Accommodator, Dino Champagne. Woo! Yay, she is the Vice President of Asset Preservation. She has been doing this for quite some time. I'm going to let her explain a little bit about her background, but I can tell you from firsthand experience, Dino is fabulous to work with. She knows her stuff backwards and forwards. She's been doing it for quite a while. She'll tell you all about that. But I am really pleased to be able to present to you today Dino Champagne. Dino, please take it away.
I will. Thank you, thank you, thank you. Now, I'm not sure quite some time. Everybody's got this vision that I'm ancient. Well, I might be. All right. So my background, I've been with asset preservation, facilitating exchanges since actually 2002. So I'm 18 years in this industry. But prior to joining asset preservation, I spent 14 years as a commercial broker, leasing and selling commercial properties. And then prior to that, see, here's where I'm getting into the ancient part. Prior to that, I spent 15 years as a commercial banker. So my whole background has been basically finance and real estate, if you will, since I was young. Anyway, the company asset preservation, it's not just me, so I don't want you to have the illusion. So when we talk about you're dealing with me, you deal with me in the beginning, but then I have a back room. As a company, we have been doing exchanges since 1990, and we have facilitated over 190,000 exchanges nationwide. This is all we focus on. We focus on facilitating the exchange, preparing all the documentation, and then helping and guiding the client through the process itself. Okay, so that's who I am. I think we're gonna, let's see, I'm gonna try to get my slides to work here. All right, so what I'm gonna cover in this short amount of time, and I know you're thinking, well, that's not short, an hour's not short. Well, it is, because I can talk on this topic probably 3 to 4 hours, but we're gonna keep it, don't worry, don't panic. We're gonna stay within the time frames. So what I'm gonna cover today is going to be basically what taxation rates, what people pay when they sell an investment property. We're going to talk about the pros and cons of doing in exchanges. I'm going to take you through IRC section 1031, holding period, like-kind property. I'm going to also bring you through what you have to do to qualify for an exchange, so the process of the exchange. And then we'll go over a couple of current matters. If there's any questions, I guess maybe you can put them in a chat box, and that, and it'll work that way. All right, so what is Section 1031? Well, it's an extremely valuable tool, and I would like to say that in the year 2020, our tax code is 99 years old. So hopefully we'll see 100, okay? In 2021, we'll have hit the centurion mark where this code has been around for 100 years in 2021. This is an opportunity for investors, for farmers, for ranchers, for business owners to basically defer tax. So one way of looking at it is considering it as the reinvestment plan. Now today I'm going to focus mainly on investment real estate, even though the code works for people that are using it for their trade or business. This code also is a good tool for estate planning purposes. So right now, and I'll talk a little bit more about this, but sometimes people use this code as a vehicle for leaving property to their heirs. So 1031 is a very, very valuable part of the tax code, and it's been around 99 and hopefully to get to 100 years. Now, let's talk about the tax rates. Why do people do 1031s? Well, you do 1031s because you're deferring tax. So let's talk about the current tax rates that an investor is going to be dealing with when they sell a property. When you own investment real estate, you're depreciating that property. So as you're operating the property, you're lowering your real estate taxable income. Now, when you go to sell the property, there is a tax rate associated with that, and that's called the recapture tax. That tax rate is at 25%. Then there's the capital gain tax rate. Now, at this point, the federal rates, they have two rates. There's 15% and there's 20%. A taxpayer is going to hit the 20% capital gain tax rate if they're a single taxpayer and their income is more than $441,551. If they're a married couple and their income is more than $496,601, then you're going to be subject to 20% tax on any gain. Anything below that is going to be 15%. So before you think, well, my income is well below this $400,000, a large gain on the sale of a Newport property could easily throw you into that 20% tax bracket. Okay, so just keep that in mind. Now, the third tax is called the net investment income tax. Most of us know it as the Obamacare tax. So basically, that's additional 3.8% if a taxpayer's income is over, if they're single and they're over 200,000, or if they're a married couple and the income is more than 250,000. So as you can see, at the federal level, you are subject to three potential taxes: the depreciation tax, capital gain, and the net investment income tax. And then there's the state of California. California doesn't have any long-term capital gain rates. It's just ordinary income. So California's tax rates range anywhere from 9.3 to as high as 13.3. So when you think about an investor doing an exchange, think if somebody had a $720,000 profit on the sale of a property. That $720,000 profit could run $255,000 in taxes, okay? That's money that's not being used for the investor. So that's going to Uncle Sam and Uncle Gavin if you're a California resident, okay, or whatever state you're in that collects taxes. So in these instances, that's money, that $255,000, that takes that money off the table for me as an investor, and now I have less to purchase property if I pay the taxes. So the beauty is we do have the 1031. So when you're doing a 1031, there's going to be pros and cons to the transaction. So let's cover the pros. A 1031 allows a taxpayer to defer. I'm not saying the word free. It allows the taxpayer to defer the depreciation recapture tax, the federal capital gain rates tax, California state taxes, because it does recognize 1031, the net investment income tax. So I get to defer those taxes. Another benefit to the exchange is I get to build my wealth by preserving equity, because I'm not giving the government my hard-earned money, my profits. I get to keep that money and go buy more property. I can also utilize leverage as a part of a strategy for 1031. So if I sell a property, for example, that has no debt, I can go buy more replacement property and accumulate and put some debt on it so I can maybe double or triple my portfolio depending on the circumstances. 1031 also allows me as an investor to diversify. Now we're seeing a lot of this right now in the 1031 world, where people are diversifying geographically. So they may be selling out of California and buying into Texas or Florida, Alabama, Georgia, Tennessee, just to name a few states. So people are moving out of one state and exchanging into another state. All right, so I can move around geographically. I can also, as an investor, move around through asset class. So I can go from, maybe I have raw land that I've had for 20 years that I've land banked. I want maybe move into something that can produce income like a single family rental or a duplex. Maybe I have an apartment building, you know, and I want to deal with a single tenant triple net. So I can move around asset class. We're going to cover a little bit of that a little bit later. I can also go into something that's easier to manage, like a Delaware statutory trust. And then I mentioned early about the estate planning. Under current tax law, and I'm specifying that because it is under current tax law. Could that change? Yes, depending on how things may change with the outcome of the presidential election, as well as the any Senate races that are going on right now. But right now, as an investor, if I exchange, pass away, my heirs will inherit my property. They will get a full step up in basis in the property. So in other words, the value of that property is going to be stepped up to the current market value. So you probably have to get an appraisal to determine that. The heirs can turn around the next day, sell it, and not pay the taxes that I, as an investor, say if it's my heirs, I, as an investor, have been deferring. So this is one of the advantages that a 1031 has. So there's some great advantages to this code. Now, cons of doing a 1031. Well, there's specific rules that you have to follow, and we're going to go through all of that. And there are time restrictions to get these things done. Another downside to an exchange, and people they don't really recognize this aspect of it, is that when you're doing an exchange, you do not get a brand new basis in the new property. Now, for those of you that may not be familiar with the term basis, that means basically what you paid for the property, okay? So if I bought a property for $300,000, that's my basis. When I sell it, my basis is going to be adjusted. It's going to be adjusted based on depreciation. It's going to be adjusted based on improvements. So when I go to sell that property, and I'm going to use that adjustment number to determine what my gain is. So if my basis at the time of sale, for example, so say my depreciation came to $100,000. Now my new basis is $200,000. If I buy a replacement property for $300,000, my basis is not $300,000. My basis is $200,000 because the gain deferred would be the $100,000 that I deferred. Okay, and that's probably sounded a little strange because I'm not showing you any numbers at this point. But the reality is that I do not get a brand new basis. So if I sell for 300, buy for 300, my new basis in the property is not 300. It's whatever my adjusted basis was when I sold. Okay, now there's ways of increasing that by buying a lot more. Now, the next downside to the exchange is that it's lack of liquidity. Basically, you have to buy real property. Any money you keep will be taxed, okay? If you have losses, you cannot recognize those losses on that transaction. So it's so important that when you're selling an investment piece of property, that you're talking to your tax advisor to determine, do you need to do an exchange or should you do an exchange based on your tax position, okay? Do you have loss carryovers? What's happening on your personal tax return that can impact this transaction? Always, always, always consult your tax advisor when you're making these kinds of decisions. Is there a possibility of higher taxes in the future? Yes, tax rates have always adjusted. Again, we don't know what lies ahead. We'll have to wait to see what the outcome of the election is. And then it's tax deferred, it's not tax free. So those are the cons, and then plus the pros of doing a 1031. Now, remember I told you about those guidelines. So there are 4 basic guidelines that an investor is going to have to deal with. One is going to be the property qualification. So is the property I'm selling property that I held for trade or business or for investment? So in other words, it can't be your primary residence. It's not a part of the 1031 code, okay? So does the property qualify for a 1031? Next requirement is going to be, well, did I purchase property equal to or greater than what I sold for? Now you can do this by buying one, you can do it by buying multiple. I'm going to cover that a little bit later. All right, so those are the mathematical requirements that you have to meet. Have to buy property equal to or greater than to try to defer 100% of the gain. The third would be, did I meet the timelines for the exchange? You only have a certain amount of time to complete the exchange. So The tax code says that you have 180 calendar days to complete the exchange or your tax filing date, whichever is earlier. So anyone that's entering into a transaction that's closing between, say, October 17th and December 31st of 2020, that means that you would need to file an extension on your tax returns to get the full 180 calendar days to complete the exchange. But the first 45 days of that period is the time frame in which you have to identify the property or properties you would like to purchase in exchange. And we're going to go over that as well. And then you have to comply with the identification rules. So it's not just a matter of saying, this is the property I want. There are specific things you must do to meet the guidelines for the exchange. Now, a very, very important part to the exchange is you must have a qualified intermediary. That's where I come into the picture of the transaction. So if you're thinking of selling your property, okay, and you're going to go out there and you're considering doing an exchange, you talk to Sherry about what you're planning on doing, and then you discuss what you'd like to buy. You know, that's their role. Once you get the property under contract, then that's when my official role begins, because you must have a qualified intermediary to comply with the tax code. So if you close the property without me, you do not have an exchange. Okay, so you actually have to have a qualified intermediary. Our function is we prepare exchange documents. So there's a written agreement that is put together, okay, once you get an escrow with the buyer. In those documents, now our documents run about 40 pages. Every accommodator maybe have a little different size documents, but ours are about 40 pages. Contained in those documents is language that says we're now becoming the seller of the property. It also has language in there that tells the escrow officer or the closing attorney, depending on the state that you're in, okay, to deed the property directly to the buyer. So in other words, while we become the seller of the property, we don't physically go on title to the property, all right? When you go to buy the replacement property, we must be assigned into that contract as well. So technically through our documents, we acquire the replacement property, but the deed is going to go directly to you as the investor. There's certain language that must be contained within these documents. If this language is missing, then you're not complying with the safe harbors of a 1031. So we also restrict you from touching your funds. So the funds come to us in the exchange. Now, one thing, I have a little note on there. It says, you know, that once the exchange documents have been signed, now we're involved in your transaction, okay? Sometimes people think if we just send some documents out, then your exchange is set up. It's set up only officially once you sign the exchange documents, and those documents must be signed prior to the closing of the sale. So our role is extremely specific to qualifying for 1031. All right, now we talked about property qualifications. One of the issues that comes in, well, we know it has to be an investment property, right? Because I already told you it cannot be your primary residence. The last use of the property cannot be your primary residence and do a 1031. Okay, there's other things we can talk about that you can do both. But for this discussion today, if the last use is your primary, it's not a 1031. All right, so when we talk about investment property, one of the questions comes in, well, how do I determine that it's been held for investment? Because that's part of what the code says. It says the property must be held for trade or business or for investment. So there's nothing specific in the tax code that mandates a required holding period, okay? So there are a couple of views that you can take a look at. One would be at least own the property for 24 months or more, so 2 years or more. Why? Because there's, you know, that helps to establish. There was a private letter ruling that showed it was sufficient. There's a revenue procedure that addresses that 24 months is sufficient, okay? But that's not your, that gives you a good idea. Then there's another view, which means, well, 12 months. Because if I hold an asset for more than 12 months, now I'm straddling 2 tax returns. If I hold an asset more than 12 months, then I fall for the long-term capital gain rate. So I fall under that ability to have long-term capital gain rates. And back in 1989, they were thinking about saying, well, you had to hold it for at least a year. It didn't pass, but that was, you know, something that was thought about. Time is only one of the factors that's looked at when you're holding a property for investment purposes. Does it mean you have to hold it for 12 months? Does it mean you have to hold it for 24? It gets down to the taxpayer's intent. Who is the one that tells you whether you've met that intent or not? It's not going to be me. It's not going to be Sherry. It's going to be between you, the taxpayer, and whoever does your tax returns. That's the discussion going to be had between between the parties, I should say. Okay, so it's not something that we say it is. It's what your tax advisor says. Okay, so always, again, I'm bringing you back to consulting your tax advisor. And on this webinar here, it might be a good time to think about, is your tax advisor the right party for you now when you're dealing with investment property? If you're just starting in this arena, okay, give some thought to that. Now, the other component about property qualifications is it has to be, when you're doing an exchange, the property you're selling has to be property that's investment or trade or business, and you have to buy property that's held for trade or business or for investment. Now, people sometimes get caught up on the words like-kind property. Well, when we talk about like-kind property, it's not single family for single family, or duplex for duplex, or apartment for apartment, or shopping center for shopping center. As you can see by this colorful picture here, all right, there's a lot of different real property that you can exchange from and into. All right, we do exchanges all the time where people are selling raw land. I mean, think of somebody, a farmer, for example, that had their crops. Now they're selling their farm, okay, maybe to a developer or not, but they want to go out and buy maybe an apartment building. Okay, so it's not farm for farm, duplex for duplex, office for office. So here's the thing that you can take away from the words like-kind property. It's investment real estate for investment real estate. And you cannot exchange something that's going to be your primary residence, at least not right away, because primary residence is not considered investment real estate, okay? Doesn't mean at some future date that you can't convert it, but again, you must hold the property and have the intent to hold it for investment purposes before any conversions. All right, so that's the property qualification. Now let's get into the actual numbers for an exchange. So when you're doing an exchange, I want you to view an exchange as a continuation of ownership of the old property to a new property. Now, the numbers I'm showing you right now are a little bit large, but you can buy more than one property in an exchange. But there's the thing that we call the exchange equation, and these are the guidelines that have to be met to try to defer 100% of the gain on the taxable portion. So you have to purchase property equal to or greater than your sale price, minus the closing costs. Now, there are going to be some closing costs that are acceptable, some that are not. I'm going to cover that a little bit later. When you buy the property, you have to spend all of the cash and replace the existing loan. So here's an example where somebody might sell for $900,000, had a loan at the time of closing of $300,000. The closing cost came to $60,000. The cash coming out of the transaction was $540,000. Purchased a replacement property for $1.2 million. In this example here, because they spent all of the cash, they have met the requirement to defer the tax. Now on the gain, now we call that boot, okay? So there's zero boot. So when you hear somebody talk about boot in an exchange, boot is the same thing as taxable. And that means that's the portion that did not get reinvested, okay? So this also is an example of leverage, because the investor in this went from 900 to $1.2 million. As long as you're spending all of the cash, you can get a loan larger than what you had to make up the difference to buy more property. All right. When you're buying multiple property, you can decide how you want to place the leverage on each and every one of those properties. Maybe you buy one all cash. Maybe you put 30% down on one. Maybe you put 50% down on the other. You don't have to, it doesn't have to be divided evenly, okay? But you just have to make sure you're spending all of the cash and replacing the debt on the sale. So this is what we call the exchange equation. To the extent that you do not do this, the portion that is not reinvested, whether it's the mortgage portion, the debt portion, or whether it's the cash portion, that's the portion you would pay tax on to that amount. So if this investor only bought something for $800,000 and they only put got a $300,000 loan and they put $500,000 worth down, they would pay tax on the $40,000 because that was not reinvested into that property, assuming they're only buying one property. So again, the exchange equation. When we have conversations, we go through all of this to do and take each person's situation and explain it out and show it how it works in that transaction. Now, let's talk about closing costs, because this comes up a lot in an exchange. So when you're doing an exchange, they're considered exchange expenses, and there are things that are not exchange expenses. So selling a property, the typical acceptable exchange expenses would be the real estate commission, the title insurance that you're paying, the escrow fees, attorney fees, closing fees, any legal fees associated with the transfer of that property, transfer tax, notary fees, recording fees, the qualified intermediary fees. Those are costs of transferring the property. Okay, so those are pretty clear cut as to exchange expenses. But there's going to be sometimes expenses on a transaction that are not considered acceptable exchange expenses and could create a tax ramification. For example, prorated rents and security deposits. If you're selling a single family rental, more than likely the tenant's not staying with the property. On a rare occasion that may happen, but most of the time, it's not, there's not going to be any prorated rents and security deposits. But if you have a duplex or a fourplex or a shopping center or office building, there's going to be prorated rents and security deposits. A lot of times it's negotiated in these contracts that the seller will credit the buyer with the prorated rents. In other words, the seller's going, I'm not going to give you the $25,000 for these prorated rents and security deposits. Therefore, you can just bring in $25,000 or less into the exchange. That $25,000 would be taxable because prorated rents and security deposits are a cost of operating the property, not a cost of transferring the property to the buyer. Another thing that comes in, lender fees, such as points or prepayment penalties. Those are all associated with the acquisition of money, not the acquisition of buying the property, although the money is being used to buy the property. I know it seems like a fine line to split, but these are the tax codes. Paying the buyer's closing costs, we see a lot of that. Not going to ruin the exchange. It just means that these items are going to be potentially taxable to the amount of gain unless there's some type of offset that can mitigate it. So a lot of times we're going to pay the buyer. So if you're doing, say, a VA loan, typically the seller's paying the buyer's closing costs. So that may be $3,000 or $5,000. If you're using exchange proceeds, so in other words, to do that, then that's going to end up being taxable. Can it be offset? That's between the tax advisor when they file your tax returns. Lender policy, any impounds, any property taxes. So if you're buying property and you're getting impounds and you're having to pay for the year and you're using exchange proceeds for that, that's going to be taxable because that's not a cost of buying the property. Okay. Same with property taxes, same with insurance. So these sort of issues, always important to have your closing statement reviewed by your accountant so you are prepared for when you file your tax returns as to what might be coming your way, thinking you have a full deferral when you may not. All right. Certain things are not going to destroy the exchange. It just means that there's going to be a spot where you might actually have to pay some taxes. All right. Now I'm going to take you through the actual process of the exchange itself. So you get your property up for, you decide you're going to put your property up for market, right? Talk to Sherry, you have your consultation there. Talk to your tax advisor to determine whether you should or need to do an exchange. You talk to a qualified intermediary, somebody like me, so I can explain to you what the exchange is, what's going to happen throughout the exchange. Escrow opens, we prepare the exchange documents through communicating with escrow. The documents are signed. When the escrow closes, the deed is going to go directly to the buyer. This is the first leg of the transaction. The money is going to come directly to the qualified intermediary. When the escrow closes, so when the closing takes place, that's when the time frame for the exchange is going to officially begin. That's when the 180 days and the 45 days starts. There's no do-overs unless there's been a presidentially declared disaster, okay? So just keep in mind, these timeframes are statutory. They are statutory. The hard part to the exchange, I will tell you, is going to be the first 45 days, because that's when you have to physically identify what you're going to buy. Now, let's just say you've got everything lined up pretty good. You're getting ready to close on your purchase. Our documents come in on the buy side. When you're ready to close, we're going to wire the funds into the closing, and then the deed is going to go directly to you. So that is a very, nice and neatly packaged cycle of the exchange. All right. I want you to keep in mind that when you're doing an exchange, you have to keep your eye on the prize, because the prize is deferring the tax. Just remember what your goal is by doing this. So while you might run into some snags here and there, just remember what it is you're trying to accomplish. Okay. Now let's talk about the identification period. Okay. And what you have to do to identify. Because like I mentioned, that's the hard part to the exchange. So there are 3 rules that are in the code that you can choose from. You only get to pick one of the 3. The most commonly used rule is the 3 property rule, which means that the taxpayer is physically identifying up to 3 addresses, but the fair market value doesn't matter. So if I sold for $900,000 and I identified a property for $1.2 million, then I identified another property for $1 million. Then I identified a third property for $950,000. I'm fine. Doesn't matter what those dollar amounts are for those 3 properties. Now, if I want to identify 4 or more, now I'm going to move out of the 3 property rule, and then I'm going to fall under the 200% rule. Under the 200% rule, I can identify 4 or more properties. But when I add up the fair market values of all of those properties, they cannot exceed 200% of my sale price. So if I sold for $900,000 and I identified 5 properties, when I add them up, the aggregate values cannot exceed $1.8 million. Now, under the 3 property rule, I do not have to buy all the 3 properties. Under the 200% rule, I do not have to buy all of the properties. My goal as an investor is obviously to buy enough property to at least meet the minimum of my exchange. Okay, but I'm not limited to having to buy all of the properties I've identified. But let me just stop here for a second. You can only purchase the properties that are on that list, that identified list. All right, and I'm going to fine tune this a little bit later. Now, if I identified 4 or more properties, but the values exceeded 200% of my sale price, now I'm in the 3rd and final rule, which is the 95% rule. So under the 95% rule, I have basically, unlimited number of properties to identify, unlimited dollar amount. But before you get excited, there's the thing. In order to qualify under that rule, you must close on 95% of the total value of all the properties you've identified. So basically, you have to buy your entire list. That is not a rule that's used very often. And if it is, you have to be very, very careful as an investor that you're going to be able to complete this transaction, or else you can put your entire exchange in jeopardy. So very important to watch what rule you're going to use. So when I'm talking to individuals, if they're selling, for example, out of California, and maybe the sale price is only $400,000. And I'll go, okay, so where are you going to buy? Well, we want to buy in California. Pretty much they're going to be limited to the 3 property rule. But if they decide, well, maybe I want to go buy something in Tennessee, or if I want to go buy something, in lower valued market, maybe Alabama or somewhere in Ohio, okay, wherever, where the prices are a lot lower, then I may be able to expand into the 200% rule, because maybe there's properties out there that are worth $75,000 or $80,000. So you can see what you're selling for, where you intend to invest is going to dictate what rule is going to be viable for your transaction. All right, so when we talk about identifying, there's an official form that you have to fill out, okay? So our company provides the taxpayer with this form. So this is what our form looks like. And it has, it tells you up at the top, are you using the 3-property rule, the 200%, 95% rule? Okay, sometimes people understand what that means and sometimes they don't, or they forgot because this is not what they do all day long. Anytime you're in a 1031 transaction, always ask questions if you're unsure. Always ask questions if you're unsure. All right, so here's the paperwork you'd be filling out on these lines that are provided if you're using 3 properties. While there's 6 on this page, you don't have to fill out all 6, because if maybe you're only identifying 1, 2, or 3 properties, you're just going to fill out the 1, 2, or 3 addresses. Now, the addresses have to have the address, the city, and the state. The address, the city, and the state. If it's raw land, the legal description or APN number, the city, and the state. Okay. You have to be able to physically identify. Has to be dated and signed prior to midnight of the 45th day. Most people go, well, when do I identify? I will tell you that when you identify is going to be closer to the 45th day, because you're not going to be identifying properties on day 15 or day 20, because you don't know for sure whether you're going to get those properties or not. And I also want to be clear that identifying does not mean that just because you're in contract. Okay, because you may be in contract with 5 properties, but you may only want to identify 3 of those 5. So you physically have to put it on this list. Being in contract does not deem it identified. Okay, so be very clear on that. So here's how the rules play out. Under the 3 property rules, I have examples here. So let's just say I sell property, 123 Main Street, Culver City, all right, California, address, city, state. Second property, address, city, state. Third property, address, city, oh, no state. You need to put the state. If you don't put the state, we don't know whether it's Norco, Louisiana or Norco, California, okay? Have to put the state. Believe it or not, people do make these mistakes. So be very, very careful. That's why I always recommend that when you're doing your identification, you're doing the formal ID, that you send it in during business hours so my team can take a look at it and say, okay, oh, hey, Scott, you're missing the state. We need you to fix this. Okay, if you send it in at 11:50 of the 45th day at midnight, 11:50 p.m., all right, they're probably not going to see your ID until the next day. When they see the ID in the next day and there's no state, it's not properly identified and you cannot correct it after that. So the identification rules are the hardest part to the exchange. And so you have to be diligent in this section of your transaction. All right, under the 200% rule, okay, so this example here, sale price $500,000. I've got 5 properties. When I add them all up, it's worth $995,000. Now, I can buy all of them if I chose to. I can buy 2 or 3 of them if I wanted to. I can buy whatever combination meets my $500,000 need for the 1031, okay? Again, 3 property rule, 200% rule, you do not have to buy everything on the list. Now, if you overstep the identification, okay, and now you exceeded the 200%, now you have to close on 95% of the total of all the identified properties. So you have to close on $992,750. And as you can see by this example, the prices don't have anything that's, let's see, under $7,250. So that's why I say you have to buy everything on your list. Be very, very careful what you're doing in the identification. And this is a part that really needs to be paid attention to very, very carefully. Okay, now, we see a lot of folks, doing multiple property exchanges. We've helped actually a few of Marshall Reddick's clients in these situations where they've sold multiple properties to maybe consolidate. So they're coming out of a few single family rentals and they're going into, a larger, like a duplex or triplex or something like that. You can do a multiple property exchange, but what you have to be aware of is that the time frame for the exchange begins at the closing of the first property. So anytime you're thinking about embarking on a multiple property exchange, make sure that we're having a very long and candid conversation about the reality of the timing of all of these closings, okay? because properties 2 and 3's 45 and 180 days starts at the same time as property 1 sold, okay? You can't close on your purchase until you've closed on your final sale. And you have to identify that purchase within the 45 days. So if you're trying to figure out, if I'm buying this apartment building over here in San Antonio, and I need properties 2 and 3, I'm filling out what I'm buying in the front end of this transaction in the 45 days. You hope that you have these other 2 properties closed in time to be able to close on that one. Can get very tricky. Now, what we see a lot of is this, where people are selling and buying multiple properties, okay? You have to close on that last property by the 180th day. So you might have a mix in your transaction of some properties that have maybe been turnkey properties are ready to go, to properties that are resale properties, to properties that are under new construction. When you're dealing with new construction, be very, very careful to the timeline, and can that contractor actually complete the property in time for you to close on your transaction. Had a transaction where somebody wanted to buy some new construction, their 180th day falls on February 24th, 2021. The construction was supposed to be completed by January 31st, 2021. That's cutting that pretty close, okay, if there's any delays for that contractor building that building. So be careful, make sure that you put yourself in a position where you're actually able to accomplish what you want to accomplish, especially in the new construction arena, all right? Now, just basically miscellaneous topics, and then I'll finish on this, and then I'll turn it back over to Sherry. Right now, we see a lot of low inventory, so that's very stressful for people doing exchanges. Okay, so be careful as to when you're getting into this, the timing. Make sure you're exploring the markets that you want to go into, check the inventory levels. If it's new construction, that may be a good vehicle, but now that looks to the timing of when you may put your sale property on the market, all right? Because if the new construction is going to be, for example, completed in May or June of 2021, you probably don't want to close, I don't know probably about it, you don't want to close, you know, in December. You may have to push that closing back to maybe February or March to give you a comfort level. All right, so, but we have market conditions that you're dealing with. So low inventory is an issue right now in 1031s. We see people struggling with it all the time. One way to combat that is maybe if you're able to, okay, everything is going to be dictated by current market conditions and the locations that you're going into. But if you find a property that you want to tie up, get under contract, you know, barring, I mean, you do the same thing with new construction, but if it's a resale, you can get under contract with the replacement property before you get under contract with your sale, and then just make sure that your closing of your purchase comes after the closing of the sale. So you can get under contract with the replacement property, just make sure you do not have the closing come before your sale has closed, okay? That will not work in a forward exchange. Talked about purchasing and selling multiple properties. Another important part to the exchange is there's a difference between exchange, taxpayer, exchange entity, and vesting. There are more times than not that people, for example, own a property. They bought it maybe in, you know, one name. They changed it during the course, but they never bothered to change the title, the formal title in the vesting part with the title companies. Now they go to sell, and then here you got, okay, so who's my taxpayer? So when you're doing an exchange, be aware, same taxpayer selling must be the same taxpayer purchasing. Can you do a partial exchange? Yes, you can do partial exchanges. It's not an all or nothing system. The key for a partial exchange is to make sure you're still benefiting from the exchange. So in brief, if the boot, the portion that's not being reinvested, is either equal to or larger than the actual gain on the sale of the property, you're not benefiting from doing an exchange. So if your gain is 50,000, your boot is 70,000, just pay the tax because you're going to do it anyway. So don't even bother with an exchange. So be aware that partial exchanges are doable. Just make sure you're still benefiting. You must be an investor to comply with a 1031, not a dealer. So if people out there doing fixes and flips, that's not a 1031. There's a product called reverse exchanges. I like to call that the exchange of last resort. It's certainly not for the weak of wallet. because the reverse exchange, you have to, where do you have the money to buy the replacement properties? If there's a lender involved, it becomes more and more difficult. And we as the qualified intermediary now physically have to go on title to a property. They're very, very expensive. So don't go, try to keep away from those if at all possible. Also be aware when you're selling in California and you're buying out of state, there's going to be an information, you're going to have to put a part of your tax returns, an FTB 3840, to show the state of California you still own that property because you deferred tax to California. So those are some of the issues that we see in today's market. Qualified intermediary, do your due diligence because we're not a regulated industry. We may have licensing in certain states, but as a whole, we're not regulated by the federal government. So how long have they been doing it? Where do they place their funds? You know, what kind of mechanisms do they have to protect the funds? All right, and do they adhere to the governing laws of each state that they're operating out of? Okay, important to know due diligence for 1031. And there you have it, 1031s. So Sherry, are you ready to take it back?
I am. Thank you so much, Dino. That is so much valuable information. You are just a treasure trove for everybody here. You can definitely count on you for a wonderful presentation, and thank you so much for spending the time with us. So
My
you
pleasure.
ask, yeah, where do we go from here? Well, now's a great time to schedule a complimentary consultation with myself, with Dino, a conference call, whatever it is that you feel comfortable. This is just the tip of the iceberg. There's so much valuable information out there. We'd love to help. Definitely contact myself, contact Dino. We'd both love to hear from you. One thing I did want to bring up is that you need to really take a look at our Marshall Reddick website. If you haven't spent time on it, I strongly urge you to do it. There is so much information, so much free and very valuable information, education, webinars, articles, mortgages. You could really educate yourself on all things real estate by looking at our Marshall Reddick website. Very simple, just go to marshallreddick.com. /learn. This webinar will also be on the website if you want to refer back to it as well. So it's definitely well worth you taking a little bit of time browsing through it. There is so much content on there that would really help you out. Anything and everything related to real estate. Also in there, you can click on the link at the very bottom, which would be for our Reddick Property Rating ebook. It's an actual book you can download to your computer, free downloadable, and it explains our process for identifying properties. What is an A-class property all the way to what is a D-class property. It's invaluable for anybody who is either a seasoned investor or is just starting out. You're going to get a takeaway no matter how far along in the process of educating yourself on real estate. So with that said, I strongly urge everyone to visit our website. If you want personalized help, contact me, contact Dino, whatever you prefer, but we'd love to hear from you. With that, have a wonderful Thursday, everybody, and we'll hopefully be hearing from you soon.
Thank you, everybody. Thank you, Dino. Thank you, Sherry. Thank you, folks, for joining us today. Everybody has a wonderful day.